and be solvent in the future. Okay? So that's liquidity, long-term solvency. So classifications. We've talked about this, current versus non-current. Okay? I gave you an example. I said current is anything to be consumed within 1 year or operating cycle, whichever is longer. Do you remember the example I gave you last week? Yes.
Winemakers' operating cycles are often a lot longer than a year.
Right, maybe longer than a year, exactly. Because why? They have to wait for the grapes to ferment. So it's cash to cash, raw materials to collecting cash on a sale. Yes? Yeah, I mean, I'm unlikely to give you something that has some strange operating cycle. What's important is that you know when you go into the real world, okay, that you may encounter companies that have an operating cycle that is more than a year. Okay? It's possible. Okay? It may not be likely depending upon the type of company that you're working with, but this is a possibility. Okay, I have that here. Current assets. So we kind of went through all this. I feel like we can not spend too much time here. And these are just different types of assets that go on that you see on the balance sheet. Okay, I had kind of skipped this. I just said current assets, usually cash and cash equivalents. Short-term investments, accounts receivable, notes receivable, inventory, prepaids, usually are within a year. We have investments here. Investments can be classified either as current or non-current, depending upon how your business uses those investments. If you plan to sell them off and trade them within a year, then they'd be considered current. Otherwise, they can be considered non-current. Did we go over trading available for sale and held to maturity? Okay. So there are different classifications of stocks or investments. Trading, available for sale, AFS is available for sale and held to maturity. So depending upon, trading securities would generally always be considered short-term. Available for sale, it could go either way. Held to maturity are likely to be non-current. So the way that I like to explain these kinds of securities, so trading, I like to say you're like out there and you're just like dating. You go on like a few dates a week. You're like constantly, have like a new guy, you go out, or new girl, whatever you do, right? So you like have a date on a Friday. Sorry, that's trading security, okay? Available for sale is like I'm going steady. I'm holding on. We're like not totally serious, but we're like going, we're like dating. We're like, I might call that person my boyfriend or my girlfriend. And held to maturity is like, I'm in it. I'm getting married, okay? We're like in it for the long haul, okay? So that's kind of like how I would think about those three different classifications. So if you're trading security, you're likely to be short term. If you're available for sale, it could go, it could be either way. And if you're held to maturity, that is non-current, right? You would hope that there's nothing currently happening, okay? So trading securities, I don't know how much I want to get into this. Trading securities, the really big difference outside of the classification on the balance sheet is that on the income statement, trading securities, you recognize unrealized and realized gains and losses in income. Available for sale securities, we did something with that. Realized gains and losses go on the income statement. Where do unrealized gains and losses go?
Comprehensive income.
Into comprehensive income, right? They're that like other, they bypass the income statement and go directly into comprehensive income. Okay? Yes?
Trading securities do go into?
Trading securities go into income because realized and unrealized gains and losses go into income. Okay, if they're classified as trading. Because the idea is that it's all short term. Held to maturity securities are recognized at what's called amortized cost. Okay? We're not going to get into what that means right now. Just be aware of this. Okay, we're not at that point just yet. We will get there. Okay. Property, plant, and equipment. I feel like this kind of goes without saying. You've taken an intro class. You should know what these things are. Intangibles. We were just talking about that before. So goodwill is not the only intangible that ends up on your books. You have lots of other intangibles that you can show on your books as well. Other assets, just it's a catch-all for things that don't go other places. You have current liabilities. Does anyone feel like I need to talk about what these things are? Current, the same idea, current, 1 year or operating cycle, whichever is longer, okay? So you classify things as current, long-term, or beyond a year. You have the equity section, you have your paid-in capital, your retained earnings, and you have treasury stock, which would be in your equity section of your balance sheet. Never going to have that on. Okay. So as I was saying, and for anyone who actually ever listens to this, on an income statement, sales goes with what account? Cost of goods sold. Does rental income belong with cost of goods? Does it have a cost of goods sold? No, so that would go separately below. Okay? Here, accounts receivable goes with the allowance for doubtful accounts. Does notes receivable generally have an allowance for doubtful accounts? No, it goes with accounts receivable. So on your balance sheet, even though you may have more than one kind of receivable, the allowance account goes with the receivable account that it relates to. So you don't list all, because I can see some of you may want to list all your receivables, then the allowance. Put it with the account that it belongs with. Inventories. In order of liquidity here, you have your finished goods, then your work in process, then your raw materials. So again, this is a lot of detail. You won't always see all this detail on a balance sheet. You may just see inventory. Okay, here we're choosing to put a lot of detail in here. Next, we have long-term investments. This may just be called investments. If it's just called investments, what's the assumption? That it's non-current. There goes to here. This says long-term. I would call this non-current. Okay? So preferred stock, land held for future plant expansion, or land held for future plant site, cash restricted for future plant expansion. These are considered investments. Like I said, you take that money, you're putting it aside for a separate purpose. Property, plant, and equipment. Again here, buildings less accumulated depreciation. Now, a little differently from what I said on the other items, sometimes, or frequently, you'll see buildings, equipment, buildings and equipment, and whatever else, furniture, less accumulated depreciation. So these won't always, where'd I go? Come back. Oh no, I have to. Oh my gosh, what did I really just do that? Okay. So these won't always have their own accumulated depreciation account broken out separately. Okay? In this case, this says buildings less accumulated depreciation buildings. So the idea is there, I guess if there was equipment, it would say accumulated depreciation equipment. However, know that on a balance sheet, you'll very frequently see buildings, equipment, furniture, less accumulated depreciation. They're not always broken out separately. Yes? Yeah, so if you have $1,000 of cash and $50 of that is restricted for future plant expansion, what's the amount you're going to show for cash? $950. That's what that's saying. Whatever you have for cash less that amount, that $50 is in here. They're just showing, they're giving you way too much detail up there. They want to be clear that the cash that's restricted is not included there. Okay? Yes?
Short-term investments like term securities,
Mm-hmm.
does that just get converted in with cash and cash equivalents?
No, it doesn't. That's a good question. That would be like T-bills and things that are due within 3 months, generally get classified as cash and cash equivalents. If you had some kind of trading, investment in trading securities, it would be part of your current assets. It would be listed as one of your current assets. But it would likely say short-term investments or something. You would just have a line there. Yes?
The cash restricted for plant expansion, because it's for the plant, would it be under?
No. It's not going to be listed under property, plant, and equipment unless you've already started like constructing the site and doing something like that. Then it would be in some kind of property, plant, and equipment. Okay? Intangible assets, you have copyright there. Liabilities, so you have all your current liabilities listed. Then you have your long-term debt, minus any discount. Okay, so premiums and discounts. So someone asked this, I want to make sure I point out. So premiums and discounts are not things that are necessarily paid over the course of a year. They're things that are amortized. So what you're going to pay within the course of the year would go into current. Everything else stays into the long term. So your premiums and discounts are going to end up with your long-term debt. Then you have your stockholders' equity section. You have common stock, additional paid-in capital, retained earnings, less treasury stock, and you have your total stockholders' equity, and then you have your total liabilities and stockholders' equity. And this number always has to equal what number? Assets, right. Okay? So if they don't equal, you've done something wrong. You have to go back and find your mistake. Okay? If your trial balance balanced, then your balance sheet needs to balance as well. Okay? Any questions? Yes, absolutely. So what we're going to do now, I'm going to go through some financial disclosure stuff, and then we're going to take a break, and then we're going to get into cash flows. And I can also leave this up during the break if you'd like. Okay? How about I do that? Do you mind if I go on and I'll put this up during the break so you guys can finish it? Is that all right, just so we can get through what we need to? All right, so in addition to reporting your balance sheet, your income statement, your statement of cash flows, statement of stockholders' equity, you also have to incorporate disclosures in the back of your audited financial statements. Companies will always have disclosures in addition to the actual financial statements, the numbers that are presented. And this is required, this full disclosure principle, one of the principles that we discussed in the foundation or the fundamentals of accounting. We have to supply all relevant material, okay? Just the financial statements themselves don't provide all that information. So for example, if I was to go back for one moment to this, buildings less accumulated depreciation buildings. What depreciation method do I use? We don't know. It doesn't tell us that information, right? Inventories. What method do I use for that? We have no idea. Okay? What's my discount on my bonds? Well, actually, we know we know the current year's discount. We don't know what it's going to look like in future years. There's lots of information